Satish Ramanathan, who is joining us on the show to talk about markets. Satish, afternoon. Thanks so much for your time. Firstly, I want to understand from you. I was just looking at some data points. How the valuation differential between mid cap and the large cap is only widening. On the one hand, large cap universe, the valuations are low, earning expectations are low, but the mid and small cap universe valuations are also at a premium, 10-year high, and also the expectation of earnings going forward. Where is the risk over here? The jaw will eventually close, right? Either large cap undervalued will start moving, or the mid caps overvalued will start moving. Which side will move first in your view?
So I think the large cap has kind of cooled off a little earlier than the mid cap and small caps. And it's also got to do with the flow of money, because the flow of money is predominantly from the local markets. So you have domestic retail and DIIs investing, whereas FIIs are either selling or keeping quiet. So either way, they typically focus on the large cap, and consequently the mid and small cap continues to outperform. Now valuations for mid and small are about that 20 to 25% premium to the large cap peers. And I think this is likely to continue if the structure of the market remains the way it is. And for the gap to converge, it either requires some change in sentiment, or it has to be induced by external flows from FIIs.
Right. Satish, also the second point I want to understand is banks. Liquidity is tight right now. RBI believes it is seasonal. Some are expecting some moves in the near term, but can't say when. Till liquidity is eased out, the deposit growth will lag the credit growth. Does it mean for a quarter or two, banking universe, NIMs could remain under pressure because they will have to give higher rates to attract more capital, more liquidity as deposits?
Yes, to some extent, the fight for capital will continue because domestic savings has come down, and banks typically tap domestic savers such as corporates and retail to lend onward. And retail savings rate has come down to some extent, and corporate capex has also revived. So corporate incremental savings would come down into the future. So it's our assumption that deposit rates will continue to remain on an upward trajectory for some time.
Right. Satish, I also want to understand from you, where do you see margin of safety coming in the market? Where are you nibbling in right now, where risk reward appears quite comfortable to you?
So I think healthcare and pharma names have gone through a long-term structural adjustment and seem to be coming out of that. Valuations are reasonable, cash flows are good. So I think pharma is one area where we are looking at. IT sector also gives a decent risk reward because the growth is not factored in, valuations are reasonable. So the IT sector is also okay. While we like India-related stories in consumption, infra, and PSUs, I think the value of safety, value of margin is more in the lower valued stocks, value stocks per se at this juncture.
Where are you trimming your positions or churning out of, where you think valuations do not justify the earnings?
So some of the infra names where execution may be a challenge, that's where we are probably trimming or reallocating some of the profits to names which are a little more defensive.
I want to come back on the PSUs once again. Yesterday, Prime Minister Modi again made a big pitch In fact, talking about how efficiencies and profitability outlook of PSUs have increased a whole lot, improved a whole lot past few years. But how much of the good news is already in the price in your view, especially defense and railways?
So, in the case of defense, we need to watch how they execute because ramping up shipbuilding or aircraft manufacturing takes time. It doesn't happen overnight, and the markets have kind of anticipated their fast execution, and there could be disappointments along the way on execution. So we are a little cautious on that side where execution could be a challenge. In the case of infra as well, we see that execution could remain a challenge. It's not that all the bottlenecks have been cleared. The pace of execution has improved, no doubt, but it's still something which we need to watch and confirm.
Which of the earnings caught your attention this time around out of the earnings season which came out? Any sectors, themes? Where the revenue growth is also there, because the large observation was that yes, profit growth is there, but revenue growth has been slightly on the weaker side.
So I think the revenue growth has been a little weak because of two reasons. One is that the volume growth has itself come down a little bit. The second is that some of the companies have passed on the benefits of lower commodity prices. So as a result, the revenue growth appears muted while the EBITDA growth has remained fairly strong. So I think we need to look at the underlying reasons for each of these categories where revenue growth is flattish and understand why it is so. In general, we think there is a slight recovery on the Agri side and a recovery on the consumption from rural India. So we think that two-wheelers would be an area where the cost benefit is favorable. And we also see some benefit in coming in from some of the IT names as well, where I think the risk reward is favorable.
All right, we'll let you go on that one. Thanks so much for joining us today, Satish. We'll take a short break.